Hey guys, it's Nick. With all the talk of increasing inflation, it's not a big surprise that retailers like Walmart and Target came out with bad earnings from increased transportation and labor costs, and their stocks took really big hits. What is a surprise is that they loaded up on inventory that people either no longer want or no longer can afford. That also includes Amazon, which now admits that they expanded into too much warehouse space and employees. So, what this means is that there is a big inventory overhang in retail inventory and probably in employees as well. So, not only could this be a sign of a spending slowdown and the beginning of a recession, but it also may be a slowdown in the labor market as well. And this is actually what the Fed was hoping for when they said inflation was transitory. And so this actually may be the excuse they need to cut back or stop raising rates. So let's see how this happened. And Zero Hedge has this article that the bullwhip effect ends with a bang and why prices are about to fall off a cliff. And so a year ago, a strategist from Deutsche Bank said that amid the panicked scramble by US wholesalers to stock up on scarce inventory as a result of snarled supply chains, it was only a matter of time before the US economy was roiled by a bullwhip or whiplash effect. So this happens when a drop in customer demand causes retailers to understock. So that's what happened during the shutdown. And so, in turn, wholesalers respond to a lack of retail orders by understocking themselves, and that causes manufacturers to slow down production. But eventually, the reverse occurs. Customer demand comes back, retailers quickly order more goods, often too much, and wholesalers and factories are caught short. And shortages occur, prices increase, and eventually production ramps up at levels that are far beyond equilibrium levels, and this cascades down the chain. And so these violent swings in availability of goods then continue back and forth until an equilibrium is eventually established. So retailers cut back on their inventory during the pandemic, but then when things looked like they were going to turn around, they scrambled to get a whole bunch of inventory. And with supply chain issues and congestion at the ports and all of this, they over ordered a whole bunch of stuff. So this is how many ships were on anchor or at approach at Long Beach. And you see there was a big bottleneck, and that has been resolved now. So now all this inventory is coming in, and the mixture of what retailers thought people wanted, people were staying home and nesting and buying things like furniture and home goods and TVs and that kind of thing. And now US retailers like Walmart and Target, which saw their prices crater as management warned that inflation is now crippling demand and snuffing profit margins. So Walmart and Target stocked up on furniture, home furnishings and appliances and building materials and garden equipment more than they normally do. And so they have this huge inventory overhang, just as people either want to go out and get experiences and not buy things, or they just can't afford them with inflation. And so this is the end of the bullwhip, the inventory to sales ratio at other general merchandise retailers. So normally their sales ratio was about 125, but right before the pandemic, 2017, 2018, it was like 120. So that means for every 100 things that you sell in a period, you keep around 120 of them in stock. And that fell all the way down to under 105 in 2020. And so retailers were scrambling, and so they overordered because they probably weren't sure they were going to be able to get these things on time with supply chain issues. So they may have thought that they weren't going to be able to get more of them. So they overordered a whole bunch, and now they're at the point of 1.34, which means if they're going to sell 100 items in a certain period, they keep 134 items of those in stock now, and that is way too many. And so it says they expect retailers to launch major discounting programs to expedite the inventory burn. So, this analyst of global supply chains said he wondered if deflation was next, as the bullwhip was about to do the Fed's job on inflation. And so, this Barron's article says why Target took a bigger hit than Walmart actually did. It says compared with Walmart, Target carries a bigger mix of discretionary items, things people want but don't need. They have larger profit margins than basics, but they're the first thing shoppers cut back on when money is tight. And so Target saw particular weakness in televisions and furniture. And an optimist might say that shoppers are pulling back on goods purchases to spend elsewhere on experiences. We'll see. Yes, we will see. Because as Goldman Sachs warned, US consumers are maxing out credit cards, and that's going to lead to late 2020 spending collapse. And here's total consumer credit that they were actually paying down during the pandemic while they're staying home. Now it's at a record high going back to 1980 even. So consumers are maxing out their credit cards probably because they can't afford to pay for the higher cost of energy and food. And so they're putting it on credit. And just like their personal savings rate went up during the pandemic when they had government checks and were staying home and not spending, now it is right back to the usual level or even under a little bit. So people are tapped out. And so even Amazon is admitting that they built out too much warehouse space and too many employees. And so they're looking to sublet or offload about 10 million square feet of warehouse space. Amazon has excess capacity in New York, New Jersey, Southern California, and Atlanta. The excess capacity is said to be more than 10 million square feet, but one source estimated it could be triple that. And that 10 million square feet is only about 5% of the square footage that Amazon added during the pandemic. So by the end of 2021, Amazon leased twice as much warehouse space as it had 2 years prior. So here's Amazon's profit margin, and you see the last 2 quarters, they were like 2.5% and 3.2%, a big decrease from the fat years during the pandemic. And these levels are even lower than before the pandemic because of the increased cost that they're having in adding all this space and employees. And it also says that Amazon was seeking to offload workers along with Walmart. The two massive US retailers are facing a staffing problem. So if consumers are tapped out and there's too much inventory and too many workers and we're heading into a recession, what's going to happen to the price of oil? Well, let's take a look what happened the last time during the great financial crisis. So the S&P 500 started falling around October 2007, and by March 2009, it had bottomed out and lost about 50% of its value. In the meantime, crude oil kept going up and peaked in June of 2008, but by January of 2009, 6 months later, it had fallen from $140 down to $40. So if we head into a really big recession, we can expect some kind of demand destruction for oil, and it will probably do the same kind of thing that it did in 2008, just being lagged by a few months. So guys, I don't think we've seen the worst of this yet. The way the S&P 500 has fallen for 7 weeks straight indicates that we are heading into a bad recession and investors are trying to get out ahead of it. Personally, I'm going to be looking to buy real companies with real earnings and decent dividends when the news is most pessimistic. I don't think we're there yet. Remember, this is not financial advice, so do your own research and make your own decisions with your money. Hope you liked this video, and I'll see you in the next one. Thanks for watching, guys.